Hello, I'm Chris Pedersen and this is Stock Watch on Wednesday the 15th of May 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few highlights from the budget. On a macro view, my perspective is a pretty boring budget. There is no real shockers, it is well flagged ahead of time. One of the big items that I think most people were pleased with was there's no major changes to super. There's a lot of concerns there in terms of whether they would tweak it even further. So here's what I see. There's some handouts to ease the pain of inflation, like $300 towards your power bill. The reality is this helps you pay the power bill, but it doesn't solve the reason why power is expensive in a country where it is plentiful and should be cheapest on this planet. The budget did not address some of the core causes of other things either. Looks like big future deficits. I'll show some charts in a minute. No reform to help productivity. This is one of the biggest criticisms that I saw. We really have a problem with productivity. In fact, I was talking to people in the university system this morning, and they're saying they have trouble getting students attending class. In fact, they don't even want to go to live lectures. They want the lectures to be taped for them to look at any time they want, whether it's 6 a.m. or midnight. I mean, it's not very good for productivity when you have such lax structure for students because it carries over into their adult life. There are some tax credits for hydrogen and solar. Let me go into solar a little bit. One of these tax credits is excellent because that's a good way for the private sector to be stimulated to put some risk capital in and develop something the government feels is important without the government spending so much money. Solar power. University of New South Wales was a leader in the technology of solar energy, meaning turning solar power into electricity. Well, the trouble is we didn't harvest it. A lot of the Chinese students went back to China with all that knowledge gained from Australia. Then they went to Wall Street to get the capital. The Chinese government gave them cheap land to build their manufacturing sites on, and the Chinese government ensures cheap labor. So everything China is doing in terms of solar power is on the back of Western capital or ideas and science. But they are making it happen and they dominate the solar supply chain. They're something like 80%. No big changes to superannuation, as mentioned. That is good. However, don't hold your breath. These are asset class performances the last 3 months. This is fascinating. Take a look at it when you have some free time. This is a chart I saw Monday. Australian budget surplus. This was probably spoon-fed by somebody in the government to Bloomberg. And look how fantastic the Albanese government is. Big deficit to surplus. Only now, this is a half truth, or is it how to lie with statistics? This second chart shows our projected forward budget deficit going forward. So short term, it's great. So we had a bleep up, but we're going back down. We have too much expenditures and it's not being dealt with. Now the other thing is there's a cycle with governments. We have elections here at maximum every 3 years. What happens is a new government comes into power. First budget, it's a tough budget. They get criticized. They're trying to get the budget under control and prioritize their election promises. The second budget is kind of neutral. The third budget is known as a Santa Claus budget because they give a lot to everybody. Not a lot, but a little bit to everybody as a bribe to get reelected. And then the cycle repeats itself. This is current thinking on interest rates that I figured I'd share with you. And right now, Wall Street is really looking at the CPI numbers tonight. Will the Fed be able to cut rates sooner? Right now, the thinking is maybe not till 2025. And these are more comments on the S&P 500 versus the ASX 200 performance. What you see when reading this is the S&P 500 the past 6 months is dramatically outperformed the ASX 200. If you're doing asset allocation, you get a certain percent in fixed income, certain percent in equities, certain percent in cash, alternatives, etc. Well, when it comes to the equity side, just buying the ASX 200 accumulation index for long-term performance, well, that is a very good choice, and you'll beat more than 75% of active equity fund managers. There is a better choice to also diversify into, and that is the S&P 500 index, which you can buy in an ETF on the ASX. This I thought is absolutely fascinating and very significant for many reasons. This is a chart showing expectations of when people would like to retire. It has gone down dramatically. That means people don't want to work as long as they currently are. I can tell you that I'm getting older myself, that as you get older, most people like what they do for a living, that they will reassess this retirement expectation. They might tweak it to be, I will maybe do this, this, and this, that I don't like my current job, but I might transition into something that I do like better. So at the age of 62 or so, people working, well, the reality is we're getting younger physiologically and mentally. So you'll be bored if you retire at the age of 60. This chart is an amazing chart that you should permanently embed into your mind. This is the US dollar index versus the 10-year US bond yield. They correlate to each other. There's a lot of thinking with currencies that it's hard to predict future currency moves. But when you look at this chart, you see there's a very high correlation between 10-year bond rate and the value of the US dollar versus its currency peers. Worth thinking about. 3 companies I want to cover today. First is Aristocrat Leisure. Code on the ASX is ALL. Yesterday it was trading at $39.86. Take a look at how it's performed. It has been an amazing performer. But then it peaked and has plummeted. I mean, not straight down, but not too far off it either. What do the numbers tell us? I happen to like Aristocrat and looked at it 6 months ago as a possible buy for Stockwatch. Trouble is, at that time I saw it wasn't really that attractive at that time. And you see from the chart that the rest of the market also cottoned on to it's not what it used to be. But looking at the numbers, first, it has a market cap of $26 billion. This company is massive. Price target. Now, I looked at 5 different brokers, and the average is $44.42. So looking back at that chart, you see that it was overvalued according to many brokers at that time, at the peak. So it makes sense that it dropped. But the question is, how much lower will it go from here? Is it attractive, not where it was, but where it is today? Because that is part of your decision. Do I buy more? Do I do nothing? Or do I sell what I have? It's always, we are where we are right now. What does the forward potential look like? The revenue growth from 2023 to 2026 is only 4% per annum. The earnings per share growth in this period is only 5% per annum. The dividend growth, well, this is very attractive. It's 12% per annum. That is a very important indicator of the health of a company. However, companies can play tricks on you. Let's take a look at the ratios and what that trick was. The PE on the 2025 earnings per share estimate of $2.23 is 17.9 times. Well, for a company with this growth rate, that's an okay PE. The yield on the 2025 dividend of 79 cents is only 2%. Free cash flow is 4.5%, which is fine. But the payout ratio on dividends, it has been around 30% for quite some time. Now, the board is moving up the payout ratio so that in like 2025, they'll be paying out around 50% of their earnings in dividend. So what are they doing? This is why the dividend is increasing at 12% per year, because not due to core earnings, but because they're paying out more of their earnings. This is a nice little trick that a lot of companies will do when they transition from growth stock to more of an income stock, and they don't want the share price to decline as they lose their growth. So they tempt you, bribe you, whatever you might want to call it, with a higher dividend yield. Aristocrat Leisure, for those who don't know, is a casino gaming systems company that includes pokies, casino management, la-di-da-di-da. Growth has slowed, as you see. They report tomorrow, 16th of May. I don't expect a huge surprise on the upside. I could be wrong. But if there's no change in current status quo, I rate it a neutral. It's not necessarily cheap nor overpriced. Commonwealth Bank, CBA, the biggest bank in Australia. It's trading around $118, yesterday $118.81. You see that it has had a significant rise since like September, October last year. Lately, it's stagnated a little bit. Let's go to the numbers. Broker 12-month price targets. This tells you a lot. I'll read them off. Baron Joey is at 95. The bank analyst there is Jonathan Mott. He's probably the best bank analyst in Australia. What his view is has a lot more influence than the other analysts when it comes to institutional investors. Citibank, they have a price target of only 80. I mean, that's huge. It's trading at 118. That's a drop of $32, or it's crazy. Then you have Goldman Sachs, 82 and change. Jardine, 102. Macquarie is at 95, same as Baron Joey. Morgan Stockbroking is 93 and change, close to 94. UBS is at 105. The average here of these is 93.36, and yet the stock's trading close to 119. Let's look at the numbers. One, it has a market cap of almost 200 billion. 12-month price target, this is mine. I have 105.80. I'm not using any discounted cash flow model, PE multiple model, nothing like that. None of the complex multiples of EBIT or whatever. I'm simply looking at the yield and saying, what is a reasonable yield with current dividend levels? I'm using the 2025 estimate. At a yield of 4.3%, I need a price of $105.80. Now at 4.3, that's actually a little bit low in yield, but you can gross it up for franking, and it's still okay. But the other banks are probably just as safe and have a higher yield. Revenue growth, well, this is a problem. For the next 3 years, revenue growth is less than 1% per year growth. Their earnings growth for the next 3 years, it's basically flat, down a little bit. Dividend growth, this is not less than 0.5% per year in dividend growth. So based on forward estimates, CBA is going nowhere. A lot of competition, net interest margin shrinking. Where are they going to find the reason to buy the company? Because with a yield of where it is now, below 4%, that's not very enticing. The PE on the 2025 earnings estimate of $5.68 is 20.9. This is crazy. CBA always trades with a PE higher than the other banks. That might be 14 or 15 times. Lately it's crept up to 16 times. Now it's close to 21 times. That's just not right. It's overpriced on that matrix. The yield with a forward dividend estimate of $4.55, that's 3.8% grossed up to 5.5%. That's nothing to retire on. The PEG ratio, I explained last week what the PEG ratio is. This is the PE divided by growth rate. Well, when the growth rate is basically 0, I'll say 1 to make the math easier. You have a PE of close to 21, so 21 divided by 1 is 21. Attractive companies typically trade with a PEG of 1.0 or less. So this tells you that by many fundamental factors, Commonwealth Bank just doesn't cut the cake. The payout ratio is 80%. Wasn't all that long ago, it was 70%. And then before then, it was around 65%. So banks can't keep increasing the payout ratio indefinitely. Now, by the way, They don't want to really have too big a payout ratio because they want to keep some retained earnings, because they need the retained earnings to buy shares back, which will help grow their earnings per share. Now, CBA is buying shares back, I believe. So even with flat earnings per share growth and they're buying shares back, that tells you the extent of the problem. Banks are generating EPS through reduced bad debts and provisioning. Right now, they're at record lows. We've been looking at banks for the past 10 years thinking that the bad, doubtful debts and provisionings can't go any lower. And it continues to get lower and lower and lower. What this means is the banks cannot afford to put any bad debts on their book. That's why they're very tough in their lending standards, because any type of downturn, there could be a huge profit blowout on the downside if they have to start increasing provisioning. It's a competitive market out there. Net interest margin is contracting. Banks have difficulty. By the way, the banks are very well managed. They happen to have a lot of different levers to pull to generate earnings. But when you don't have revenue growth and your cost to income ratio is kind of steady, where else are you going to get growth if you now have record low, bad, doubtful debts and low levels of defaulted loans? It's getting difficult. I rate Commonwealth Bank as avoided. Last company, QBE Insurance, symbol QBE on the ASX. It's trading around $17.33. I've liked this company for quite some time, and I recommended this about 6 months ago. Look at the chart. It's continuing to perform. There are many positives from it. And you go, insurance. Well, geez, I've been reading insurance companies have a lot of problems these days because they have so many bad insurance policies where they got to make huge payouts because of these massive storms and et cetera. Well, one of the things is insurance companies use reinsurance to share the burden. But insurance companies also raise their premiums to offset the raised levels of risk. Now, looking at QBE, they have a market cap of $26 billion. This is huge. Price target is 21. This is a UBS price target, and I also think it's reasonable. Revenue growth rate from 2023 to 26 is 16% per annum. Excellent. Earnings growth during this period, 14% per annum. Dividend growth, 19% per annum. It has all the right positive ticks. The PE on 2025 earnings estimate of $1.90 is only 9.1. This is cheap. Yield on the 2025 dividend estimate of $1, some brokers like 98 cents, 97, I rounded it to $1, is 5.8%. That's a good yield. The PEG ratio is 0.65. That is excellent for a large cap blue chip company. Payout ratio is 49.5%. That's good because they have retained earnings for potential blowout in claims. But also, QBE is a multinational general insurer, so they diversify around the world. Just because there's a storm in Australia doesn't mean there's a storm in Europe. It has a NEP margin, which is 11%. What NEP stands for is net earned premium. What is attractive right now is that they are raising premiums and the rate rises are sticking. The competition is also raising rates. Sometimes one insurer will raise rates, the others don't follow, and then the first one has to drop back down to be in line with the competition. Everybody's raising rates, which is good for shareholders, but not good for you and me who need to buy QBE insurance for your car, home, or whatever. One reason it has a low PE ratio is the market has marked down insurers overall due to the unknown size of future calamities such as hurricanes, typhoons, floods, what have you. I rated to buy. Most brokers in Australia rated to buy. As always, if you want to learn more about anything I covered today, send an email request to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. Thank you for your time. I hope you have a profitable week.